The foundation of American financial dominance is cracking, and what you are about to learn will change how you see the United States economy forever. Over $5 trillion vanished from Wall Street in a matter of days. Foreign money is rushing out of the country at speeds never witnessed before, and the dollar itself, once the world's most trusted currency, is suffering its steepest decline in over 50 years. These are not temporary market corrections. They are warning signs of something far deeper, far more structural, and far more dangerous than most people understand. This video exposes three interconnected forces that are currently reshaping global finance and threatening American economic stability. First, the market crash that stunned the world. In early April 2025, President Trump announced sweeping tariffs that sent shockwaves through every corner of global finance. Within just 2 trading days, more than $6 trillion in value was erased from American stock markets. The S&P 500 experienced its worst single-day loss since the depths of the pandemic. The Nasdaq plunged into bear market territory, and major American companies like Apple, Tesla, and Nvidia saw hundreds of billions wiped from their market capitalization in mere hours. This was not a normal market correction. It was a violent rejection of policy decisions that investors believe could push the economy toward recession. The speed and severity of the collapse exposed just how fragile the foundation beneath Wall Street really is. Second, foreign investors are abandoning United States assets at an alarming pace. Data from central banks reveals that foreign official holdings of U.S. Treasuries held at the Federal Reserve have dropped by $48 billion since late March. This is not a rotation into other investments. This is a fundamental loss of confidence in American financial stability. Foreign buyers, who control roughly 30% of the Treasury market, are reducing their exposure to U.S. debt, dumping bonds at a time when the government needs them most. China has been cutting its Treasury holdings for years, and now other nations are following. Even worse, the traditional safe haven appeal of U.S. bonds is breaking down. For the first time in living memory, investors are selling both American stocks and treasuries at the same time, signaling a belief that the entire U.S. financial system may no longer be the secure refuge it once was. Third, the U.S. dollar is in freefall. The dollar index posted its biggest loss in the first half of 2025 since 1973, falling roughly 11% from January through June. This marks the end of a structural bull cycle that began in 2010 and had made the dollar one of the strongest currencies in the world. Now, foreign investors who hold trillions in dollar-denominated assets are rushing to hedge their exposure, which only accelerates the currency's decline. Every percentage point drop in the dollar weakens America's ability to borrow cheaply, raises the cost of imports, and reduces the purchasing power of every household. The dollar's collapse is also a strategic blow. For decades, the world's reliance on the dollar gave the United States enormous economic and political leverage. That leverage is now slipping away as nations look for alternatives and as confidence in American leadership fades. You will learn how these three developments are connected, why they happen now, and what they mean for your savings, your investments, and the future of the American economy. You will see the warning signs that experts ignored, the hidden risks inside financial markets, and the deeper forces driving capital away from the United States. By the end of this video, you will understand why this moment may represent a turning point in global finance, and what indicators you must watch closely in the months ahead. This video will also reveal the strategic decisions that triggered these events, including the role of aggressive tariff policies in sparking panic, the quiet shift by central banks away from dollar reserves, and the breakdown of trust in U.S. fiscal responsibility. When these pieces come together, a clearer and more troubling picture emerges, one that shows how American financial supremacy may be eroding in real time. So stay with us until the end. The story is larger than a single headline, and every piece matters. There is far more happening beneath the surface than most people realize, and you deserve to see the full picture without noise or confusion. Welcome to our channel where we break down global finance in simple and clear language. If you want more videos like this, make sure to subscribe and support our work. The market crash that shook the world. In early April 2025, Wall Street experienced one of the most dramatic and destructive market events in modern history. On April 2nd, President Trump announced sweeping tariffs on virtually all U.S. imports, including a minimum 10% baseline tariff and country-specific rates ranging from 11 to 50%. The announcement triggered instant chaos across global markets. Within 48 hours, over $6 trillion in value was wiped from American stock markets, marking the largest two-day loss in history. The S&P 500 plunged nearly 6% on April 4th alone, its worst single-day performance since March 2020, during the height of the pandemic panic. The Nasdaq Composite fell over 6%, officially entering bear market territory with a 20% decline from its February peak. The Dow Jones Industrial Average shed more than 4,000 points across two trading sessions, leaving retirement accounts, pension funds, and individual investors reeling from massive losses. What made this crash particularly alarming was its breadth and speed. Every sector of the market was hit. Technology giants like Apple saw over $300 billion erased from their market value in a single day. Tesla lost 10% in one session. Nvidia and other semiconductor stocks collapsed as investors realized that tariffs on imports from China, Taiwan, and other Asian manufacturing hubs would devastate supply chains. Retailers like Nike, Lululemon, and Target, which rely heavily on overseas production, suffered double-digit percentage losses. The volatility index, often called Wall Street's fear gauge, spiked to levels not seen since the 2020 crash. The damage extended far beyond U.S. borders. Japan's Nikkei 225 index suffered one of its worst single-day losses in history, plunging over 12%. South Korea's Kospi index fell nearly 9% so quickly that trading was halted for 20 minutes, the first such interruption in 4 years. European markets also collapsed, with major indexes in Germany, France, and the United Kingdom all posting significant losses. Investors were not just reacting to the tariffs themselves, they were responding to the uncertainty and chaos surrounding how they were implemented. The tariffs were rolled out with little warning, minimal consultation with businesses or trading partners, and constantly shifting details. On April 9th, after a week of market carnage, Trump announced a 90-day pause on tariffs for most countries, but maintained and even escalated rates on China to 104%. The whiplash only deepened fears that policy was being made impulsively, without regard for economic consequences. According to Bloomberg, the total global equity value destroyed across those initial days reached approximately $10 trillion when international markets are included. That figure represents roughly 10% of global GDP, more than the combined economic output of 150 countries. This was not a minor correction or a temporary dip. It was a full-scale repudiation of policy decisions that markets believe could trigger a global recession. The crash also revealed deeper structural weaknesses. Many analysts noted that corporate earnings had already been under pressure from high interest rates, inflation, and slowing demand. Companies were refinancing debt at much higher rates than before, squeezing profit margins. Supply chains, still recovering from pandemic disruptions, were fragile. Zombie companies, firms that survive only by rolling over debt without generating real growth, were finally being exposed as interest costs rose. The tariff shock hit an economy that was already vulnerable, and the result was a violent unwinding of positions across every asset class. Even Federal Reserve Chairman Jerome Powell, typically cautious in his public remarks, warned that the tariffs could have a persistent impact on inflation, raising concerns that the Fed might be forced to keep interest rates higher for longer despite weakening growth. That comment alone sent shockwaves through bond markets as investors realized the Federal Reserve might not be able to rescue the economy this time. Foreign investors flee American assets. The market crash was severe, but what happened next was even more troubling. Foreign investors, who have long been the backbone of demand for U.S. financial assets, began pulling out. Data from the Federal Reserve shows that foreign official holdings of U.S. Treasuries held in custody at the New York Fed fell by $48 billion between late March and mid June. This is not normal rotation or portfolio rebalancing. This is a signal that confidence in American financial stability is eroding. Foreign investors hold approximately $30 trillion in US assets, including about $16 trillion in equities and over $8 trillion in Treasury securities. For decades, these holdings have been critical to financing the US government and supporting stock market valuations. When foreign demand weakens, the entire system becomes less stable. Now, for the first time in years, that demand is clearly faltering. Central banks and sovereign wealth funds, which have historically been reliable buyers of US debt, are stepping back. Holdings of treasuries by foreign official entities have been essentially flat since the pandemic, and recent data suggests they are now selling. China, which was once the largest holder of US treasuries, has been steadily reducing its holdings for years. As of March 2025, China held $757 billion in treasuries, down from over $900 billion in 2022. This reflects both trade tensions and a deliberate strategy to reduce exposure to US assets. What makes the current situation more concerning is that it is not just China. Japan, the largest foreign holder of US debt with over $1 trillion in treasuries, has kept its holdings relatively stable, but analysts warn that even Japan could begin reducing exposure if the dollar continues to weaken or if US fiscal policy becomes more unpredictable. The United Kingdom, which recently overtook China as the second largest holder, is widely understood to serve as a custodial center for hedge funds and institutional investors. The fact that holdings under UK accounts are growing suggests that private investors are increasingly routing their treasury purchases through offshore vehicles, potentially to maintain flexibility for quick exits. The broader pattern is clear. Foreign private investors sold US notes and bonds aggressively in April, even as official entities remained cautiously neutral. By June, the trend had accelerated. Analysts at State Street Global Advisors noted that the sudden rise in Treasury term premiums, which measures the extra compensation investors demand for holding longer-dated bonds, was driven primarily by tactical outflows rather than structural reallocation. However, they warned that if foreign capital continues to leave, the distinction may no longer matter. Tactical flows can quickly become structural if confidence does not return. One of the most alarming developments is the breakdown of traditional market relationships. Historically, when stocks fall, investors buy treasury bonds as a safe haven, pushing bond prices up and yields down. This dynamic has been a cornerstone of financial stability for decades. But in April 2025, both stocks and bonds fell simultaneously. Investors sold treasuries even as equity markets collapsed, signaling a loss of faith, not just in specific assets, but in the entire US financial system. The yield on the 10-year Treasury, which had been around 4.18% in early March, spiked above 4.6% by mid-April, a move that shocked traders and government officials alike. Foreign investors are also increasing their hedging activity. Europeans alone hold about $8 trillion in US bonds and stocks, and roughly half of those holdings are unhedged, meaning they are fully exposed to currency risk. As the dollar has weakened throughout 2025, foreign investors have begun adding hedges to protect themselves, which effectively means selling dollars. Even a small increase in hedging demand can move currency markets significantly. With $16 trillion in US equities held by foreigners, every 1% increase in hedging represents $160 billion of dollar selling pressure. The implications are severe. If foreign investors no longer see US assets as safe, the Treasury Department will be forced to pay higher interest rates to attract buyers. This comes at a time when the federal deficit is already at historic highs, and interest payments on the national debt are consuming an ever larger share of government revenue. Higher borrowing costs would force painful choices, cutting spending, raising taxes, or accepting even larger deficits. None of these options are politically popular, and all of them would weaken economic growth. The loss of foreign confidence also undermines the dollar's status as the world's reserve currency. For decades, The United States has benefited enormously from the fact that global trade is conducted in dollars and that foreign governments and institutions hold vast dollar reserves. This system, often called the petrodollar or dollar hegemony, has allowed the US to borrow cheaply, run large deficits, and exert global influence. But that system depends on trust. When trust erodes, the privileges that come with it erode too. The dollar's historic collapse. The third pillar of American financial dominance, the US dollar, is now in serious trouble. The dollar index, which measures the greenback's strength against a basket of major currencies, fell approximately 11% in the first half of 2025, marking its biggest loss since 1973. This decline ended a structural bull cycle that began in 2010 and had driven the dollar to multi-decade highs. Now, analysts at major institutions like Morgan Stanley predict the dollar could fall another 10% by the end of 2026. The dollar's collapse is not just about exchange rates. It reflects a fundamental shift in how the world views American economic leadership. After Trump's April tariff announcement, both US stocks and the dollar fell simultaneously, a rare and troubling combination. Typically, when stocks decline, investors buy dollars as a safe haven currency. The fact that the dollar also weakened suggests that global investors were losing confidence not just in American assets, but in the United States itself. The policy environment created by the Trump administration has driven much of this shift. Aggressive tariffs, unpredictable decision-making, strained alliances, and concerns about fiscal responsibility have all contributed to doubts about America's long-term stability. Foreign investors are questioning whether the United States remains a reliable steward of the global financial system. Those doubts are translating directly into selling pressure on the dollar. China has been among the most aggressive in reducing dollar exposure. In addition to cutting treasury holdings, China has been accumulating gold at a rapid pace, adding significant amounts to its reserves for months. This is a clear signal that Chinese policymakers are preparing for a future where the dollar plays a smaller role in global finance. Other central banks have followed suit, increasing their gold reserves as a hedge against currency risk and financial instability. When central banks buy gold aggressively, it typically means they are worried about the long-term value of fiat currencies, especially the dollar. The euro has surged to 1.17 against the dollar, defying widespread predictions at the start of the year that the two currencies would reach parity. The British pound, Japanese yen, and Swiss franc have all strengthened significantly against the dollar. Gold prices have soared above $3,000 per ounce, a record high driven by investors seeking safety outside of dollar-denominated assets. Even Bitcoin and other cryptocurrencies have seen increased interest as alternatives to the dollar. The consequences of a weaker dollar are far-reaching. Import prices rise, putting pressure on inflation and reducing the purchasing power of American consumers. Companies that rely on imported components face higher costs, squeezing profit margins and potentially forcing layoffs. The cost of borrowing increases as foreign investors demand higher interest rates to compensate for currency risk. Government debt becomes more expensive to service and the federal deficit grows. On the positive side, a weaker dollar makes American exports more competitive, but the United States is no longer primarily a manufacturing economy. The services sector dominates, and many services do not benefit from currency depreciation the way manufactured goods do. Moreover, the tariffs that triggered the dollar's decline are simultaneously making it harder for American companies to export as other countries retaliate with their own tariffs. The net effect is likely to be negative. Perhaps most troubling is the strategic dimension. The dollar's status as the global reserve currency has been a cornerstone of American power for over 70 years. It allows the US to run persistent trade deficits without facing the currency crises that other countries would experience. It enables the government to borrow at lower rates than would otherwise be possible. It gives the United States leverage in international negotiations and the ability to impose sanctions that other countries cannot easily circumvent. All of that is now at risk. If the dollar continues to weaken and foreign investors continue to reduce their holdings of US assets, the United States will face a painful adjustment The government will need to either cut spending, raise taxes, or accept much higher borrowing costs. The economy will grow more slowly. Living standards will decline. The global influence that Americans have taken for granted for decades will diminish. These are not abstract risks. They are real, immediate threats that are unfolding right now. The deeper connections. When you step back and look at these three developments together, a pattern becomes impossible to ignore. The market crash, the flight of foreign capital, and the dollar's collapse are not separate events. They are different symptoms of the same underlying problem, a loss of confidence in American economic leadership. The tariff policies that triggered the market crash were intended to protect American industry and reduce trade deficits. But they have achieved the opposite. They have increased uncertainty, disrupted supply chains, and triggered retaliation from trading partners. Companies are facing higher costs and weaker demand, pushing some toward bankruptcy. Investors are fleeing American assets because they no longer believe the policy environment is stable or predictable. Foreign investors are abandoning U.S. treasuries because they see a government that is willing to take enormous risks with its fiscal position and its relationships with allies. The United States already has a national debt exceeding $34 trillion, and the annual deficit continues to grow. Interest payments on that debt now consume over $1 trillion per year, more than the entire defense budget. If foreign buyers step back and demand higher yields, those costs will rise even further, creating a vicious cycle of higher debt, higher interest, and weaker growth. The dollar's decline is both a cause and a consequence of these dynamics. As confidence in American stability weakens, investors sell dollars. As the dollar weakens, import costs rise, inflation increases, and the Federal Reserve is pressured to keep interest rates high, which slows growth and increases financial stress. This creates more reason for investors to pull back, which weakens the dollar further. These feedback loops are accelerating. Each shock amplifies the others, creating a fragile system where small disruptions can trigger large consequences. A single unexpected event, a geopolitical crisis, a corporate bankruptcy, a shift in Federal Reserve policy, could push the entire structure over the edge. What makes this moment particularly dangerous is that the traditional stabilizers are not functioning. The Federal Reserve has limited room to cut interest rates because inflation remains above target. The federal government has little fiscal space to launch stimulus programs because the debt is already at historic highs. International cooperation, which helped resolve past crises, is weakened by strained alliances and rising nationalism. The safety nets that once protected the global economy from severe downturns are either exhausted or unavailable. This is not a prediction of imminent collapse, but it is a recognition that the margin for error has become dangerously thin. The forces that kept American financial dominance intact for decades, strong economic growth, fiscal discipline, reliable institutions, trusted leadership, are all under pressure. When the foundation weakens, even a solid-looking structure can fail. Key indicators to watch. There are several key indicators that can help you understand where the economy is heading and how much pressure is building beneath the surface. Tracking these signals will give you early warning of potential trouble and help you make informed decisions about your finances. Treasury yields are one of the most important indicators. Watch the 10-year and 30-year Treasury yields closely. When yields rise sharply, it means investors are demanding higher compensation to hold U.S. debt, which typically signals concerns about fiscal stability or inflation. Sudden spikes in long-term yields can also indicate that foreign buyers are stepping back. Pay attention to the spread between short-term and long-term yields. A steep curve often precedes rate cuts and economic slowdown. Foreign holdings of treasuries are another critical measure. The Treasury Department publishes monthly data on foreign holdings. If major holders like Japan, China, or the United Kingdom continue to reduce their positions, it suggests that confidence in U.S. debt is weakening. Watch also for changes in Federal Reserve custody data, which tracks treasuries held on behalf of foreign central banks. Sharp declines can signal foreign official selling. The dollar index provides a clear view of currency strength. A sustained decline in the dollar index indicates that global investors are losing confidence in the US economy or seeking better returns elsewhere. Pay attention to how the dollar behaves relative to safe haven currencies like the Swiss franc and Japanese yen. If the dollar weakens against these currencies during periods of market stress, it is a red flag that the traditional safe haven appeal of the dollar is breaking down. Stock market volatility, measured by the VYX index, is a useful gauge of investor fear. Spikes above 30 or 40 typically indicate heightened anxiety about the economic outlook. Prolonged periods of elevated volatility suggest that markets are struggling to price in future risks. Watch also for correlations between stocks and bonds. If both fall together, it indicates a broader loss of confidence in financial assets. Gold and precious metal prices often rise when investors are worried about currency devaluation, inflation, or geopolitical risk. Sustained strength in gold prices, especially above $3,000 per ounce, reflects concern about the stability of fiat currencies and the long-term outlook for the global financial system. Watch also for increased gold buying by central banks, which is often a signal that governments are preparing for currency instability. Corporate bankruptcy filings provide insight into stress at the company level. Rising bankruptcies, especially among previously stable firms, indicate that high interest rates, inflation, and weak demand are overwhelming businesses. Sectors like retail, manufacturing, and transportation are often hit first. Tracking these filings can give early warning of broader economic weakness. Interest rate decisions by the Federal Reserve are critical. Every rate change affects borrowing costs for businesses, households, and the government. Pay attention to the language in Fed statements and press conferences. If the Fed signals concern about financial stability, or if it pauses rate cuts despite weak growth, it suggests the economy is facing conflicting pressures that are difficult to manage. Policy changes in China and other major economies also matter. China is the world's second largest economy and a major player in global trade and finance. Announcements about stimulus measures, currency policy, or trade negotiations can have immediate impacts on global markets. Watch for shifts in Chinese treasury holdings, gold purchases, and currency intervention. In this environment, a few practical steps can help protect your financial position. Diversify your investments across different asset classes and geographies to reduce exposure to any single risk. Hold some cash or cash equivalents to take advantage of opportunities if markets decline further. Be cautious about taking on new debt, especially variable rate debt, as interest rates may remain high or even rise. Stay informed about economic developments by following reliable news sources and analysis. Consider speaking with a financial advisor who can help you assess your specific situation and adjust your portfolio as needed. The signs we explored today. The signs we explored today point to three powerful forces reshaping the financial landscape. A historic market crash showed how violently investors can react when policy becomes unpredictable and destructive. The flight of foreign capital from US assets reveals a deeper loss of confidence in American stability and leadership. And the collapse of the dollar signals that the privileges and advantages the United States has enjoyed for decades are now under serious threat. Each pillar matters on its own, but together they reveal a system under stress from multiple directions. When markets crash, foreign investors flee, and the currency collapses, it is not just noise. It may be the alarm bell. The foundation of American financial dominance built over decades is cracking. The world is watching, and the world is adjusting. Capital is flowing away from the United States and toward other regions that offer more stability, more predictability, and more trust. This does not mean the end of American economic power. The US economy remains the largest in the world, and its financial markets are still the deepest and most liquid. But the trajectory is troubling. If policy continues to undermine confidence, if deficits continue to grow, and if foreign investors continue to pull back, the adjustments ahead will be painful. The American standard of living, built on cheap borrowing and global dominance, may not be sustainable in a world where the dollar no longer reigns supreme. If you found this breakdown helpful, make sure to hit like and subscribe to our channel. We will continue tracking these developments and bringing you clear, simple explanations of the stories that truly matter. The economic landscape is shifting rapidly, and understanding these changes is more important than ever. Stay informed, stay prepared, and stay with us as we navigate what may be one of the most significant economic transformations in modern history.